Good evening, everyone. Thank you very much for joining us. My name is David True. Many of you who've attended NIPE events before certainly know that, so I won't waste much time further with that. I'm very, very happy for you to join us, that you're joining us tonight. This is this is our second or third event that we've done with Pay CLT. Now, you guys know NIPE. NIPE has been around for, God, 10, 12 years now. We've done scores of events. But recently we connected with some colleagues down at Pay CLT and started doing events jointly. And Cody Lee represents Pay CLT. You can see her up there. And I'll let her just talk a little bit about Pay CLT.
Hi, everyone. It's nice to meet you. My name is Cody. I am the outreach lead for Pay CLT, which is an analog to the NIPE experience. So we lead monthly or semi-monthly speaker series and kind of events in the Charlotte area. So always looking for virtual participation. Some of our events are in person, but many are still virtually. So feel free to check us out, Pay CLT on LinkedIn or Pay CLT online. Thanks all.
So thank you very much, Cody. And this is great. We'll be doing more events with Pay CLT over, we're doing one or two more this year, and I'm sure more into the new year. And we finally got the two logos up so you can see them when you go to register. To that point, I wanted to apologize, guys. We had been having some problems with our website over the last few weeks. We are migrating to a new host soon. But if those of you had issues trying to get in, mea culpa, we'll get this fixed. Anyway, so I mentioned NIPE. We've been around for a while. We do, now that we're in a virtual world, we do events pretty much once a month. We, at some point, we'll get back to in-person events, but we'll do some split of the two because clearly this allows us to broaden the reach and people don't have to be here. One thing that makes NIPE possible is sponsorship. And I wanted to give huge thanks to our sponsors, those Davis Wright Tremaine, and Further Advisory, and both of them are very generous in helping us support what we do here because we're a volunteer organization, and now that we're not doing in-person events, we can't even charge you for beer. So the sponsorship becomes very, very important. So thank you very much to DWT and to Further Advisory. So a little bit of housekeeping. Questions, please use your chat function for questions. We'll try to get to those we can during the event, in the flow of the event, and otherwise we'll have a few minutes at the end to cover questions that we didn't get to during the event. Please turn off your camera and your microphone if you're not one of the panelists, or I'll turn off my microphone when I can, but if you're not, just to keep the screen focused on those people who are providing the content here for this evening. The event will be followed at the top of the hour by a couple of breakout sessions. Those of you who've attended before are familiar with that. What we'll do is it gives you a chance in a smaller group of 6, 8, 10 people to interact in that way. So that's the way the event should run. I think I've covered all the housekeeping elements. And so now I think I'll just go into passing it over, introducing the folks who are online here. So we're very, very, very fortunate to have, and I'll do a little clarity here. We have Alexander Monroe. Hi, Alex. And we'll have Alexandra Barrage and Sarah Ellenson. I want to thank them in advance for making a little time this evening to take part in this discussion. And I'll pass it off to them to let them do a little introduction. So why don't we start with you, Alex, since I introduced you first.
Yeah, thanks, David. And it's a pleasure to be here. I want to especially thank the PayCLT team for helping me get to this point with you guys. They've been a wonderful couple of partners down there. I'm the CEO of Dandelion Networks. We're a base layer technology, also known as a layer 1 transaction smart contract network. We're designed to relieve the constraints of most of what we call the last generation digital or distributed ledger technologies. Now that kind of entails generally blockchain. So all of those problems that you've probably seen around blockchain, particularly on security, speed, reliability, trusted networks, compliance especially, all of those issues we were designed to alleviate. Our primary goals right now are to get and continue growth with our B2B customers. We manage real-time gross settlements internationally. That requires remittances, AML, CFT, alongside our partners, and we provide all the APIs to facilitate those. Lastly, we also give our retail bank partners digital wallets so that they can drive and manage their own customer engagement, either via the wallet or to push whatever their own products and engagement plans are.
Cool. Then I think Alexandra.
Thank you. Good evening, everyone. I'm Alexandra Barrage. I'm a partner with Davis Wright Tremaine. I'm very happy to be here. My legal practice is a bank regulatory practice primarily. I spent about 7 years at the FDIC as both a legal counsel and a senior policy executive. And I also co-lead my firm's blockchain practice. Our clients are a range of banks and non-banks, stablecoin issuers, exchanges, technology companies. And so very happy to be talking about this very timely topic of stablecoins, and looking forward to talking a little bit about some of the more recent legislative developments that we've seen out of the House. So thank you very much, David.
Sarah, last but not least, there you go.
Thank you, David. Sarah Ellenson, I'm a partner based in New York with EY Parthenon. I am our payments and fintech strategy leader, and I spent a lot of time working with maybe some of the same types of clients, or maybe even the same clients as Alexandra mentioned. So some of the crypto natives, some of the TradFis, and fintechs who are exploring both stablecoin opportunities as well as other blockchain and crypto use cases.
And well, thank you guys. Thanks for the introduction. One thing I may do at times, in addition to just throwing out some questions and series, if there's an acronym that I don't get, I sometimes make the assumption that other people might not get it either. So forgive me in advance, but sometimes we all operate in worlds where we have shorthand and ways of talking about things. So but I mean, we've probably all been in conversations or discussions where we got the verbs and the prepositions, but we didn't get the nouns because they were all in acronyms. So anyway, so this is much in the news. I think Alexandra just said there was a headline I just saw somewhere on the Washington Post, which is sort of misleading. It was from Bitcoin to stablecoins, crypto's history as a house of cards. So I mean, there's all sorts of noise and talk going on around these things. I think it's a great conversation. I think a good starting point is just to kind of say a little bit about what they are. What are stablecoins? And so I'll maybe kick it over to you, Sarah, to get things started.
Thanks, David. I think let's just go to the basics, right? Stablecoins are exactly what they sound like and nothing like what they sound like. So they are blockchain tokens that are intended to hold parity with an underlying asset. And there are a couple of different kinds of stablecoins, and people describe them in different ways, but generally there are the asset-backed or payment stablecoins or the algorithmic stablecoins. As in terms of the asset-backed, we like to think about them in a couple different categories. You can have fiat-backed coins, right? So that would be a stablecoin that is pegged to a fiat currency such as the US dollar. And incidentally, the vast majority of stablecoins that are out there are pegged to the US dollar as opposed to a euro or other currency. We can have crypto based or backed stablecoins. Maker DAI is an example of stablecoin that is pegged to underlying crypto. We can have commodity backed stablecoin. So think of gold forming the peg behind a stablecoin, and then, as I mentioned before, sort of that fourth category, algorithmic stablecoin, like Luna Terra, which is the
poster child
one that we all hear about, and so algorithmic have gotten certainly a bad name as a result of some pretty public failures over the last couple of months.
So, the name is stablecoin. So what makes them stable, and what are the risks to that stability? I know, Alexandra, we talked about this a little bit earlier.
Yeah, so if we're talking about the payment stablecoin, right, there are several characteristics of that stablecoin that make it stable. right? So the first one is, how reserved is it? Is it fully reserved, meaning it's a 1-to-1 to the reference asset like the US dollar? So fully reserved is a marker of stability. How quickly you can redeem your stablecoin back to fiat is another marker of stability. In some cases, it might take you several days to redeem your stablecoin, but in other cases, it might be closer to real-time, instantaneous redemption. The closer you can get to, I think, real-time redemption, the fewer risks that you potentially incur as a stablecoin investor or stablecoin customer of the issuer. But I think the other component to think about is in terms of what's backing that stablecoin. Is it cash? Is it another kind of high quality liquid asset like government securities? Sometimes, we don't really have a lot of visibility into what reserves are backing any one stablecoin. There is a real range in practice across major stablecoin providers in terms of what they make public, how often they make this information public, whether they're audited, whether those reports are public. And so I think that's creating a lot of consternation now, or it has been across the regulatory community. And so again, is it fully reserved? What's backing it, and how quickly can it be redeemed? I think are three characteristics that are markers of stability.
One thing is that when Sarah was just talking a moment ago, if you've got a stable coin that's backed with other cryptos, how stable can it be? Anyone want to take that one? Alex, you're smiling. You want to?
Yeah, I think it's the perennial problem. So just to back up, and I think it's worth putting on the table the Terra Luna issue about what went wrong. So a lot of stable coins deal with the same kind of trading models that you would find for any underlying security or trading derivative instrument, whatever the case may be, which is to say that there's kind of a supply demand equation that these guys go by. In the case of Terra Luna, they basically had slippage between each other, and they figured that they could sort of macroeconomically balance between the two. And that doesn't actually make any sense in isolated cases, which meant that in black swan events, it would pretty much collapse and spin wildly out of control on its own death spiral. That said, the more things that you can interoperate with or exchange with, so for an example, US dollar is almost ubiquitously exchangeable or fungible with something else. And as a result, it has an incredible stability because it is so easily exchanged and transacted. So to your point about if you create a stable coin that only is backed by other crypto, well, crypto is still its own emergent market. There are, what now, 3,000 different coins of various volatilities, value, and applicability. Of that, you can kind of imagine that if you're fully exposed to that and you're only backed by other crypto, well, you've kind of isolated and you've concentrated your risk around that one kind of community, which means you're totally susceptible to the rise and fall and the wonderful roller coaster that is the crypto universe.
Alex, you had to look at you were on the verge of saying something.
Yeah, I was going to say, a stable coin backed by crypto in some ways is kind of anachronistic, right? Because the stable coin is supposed to have a fixed value.
It's an oxymoron.
And the Bitcoin thing, we know that's pretty volatile, right? We've seen that, Lunaterra, right? And so, yeah, it is kind of oxymoronic to think of that, but these products exist, they're out there. And I suppose if you're aware of those risks and you have visibility into what is backing, your stable coin, there's an argument that that's a risk you take on, but it also suggests that maybe that shouldn't be called a stable coin because the word stable could be misleading to many people, and that's another issue out there.
So, yeah.
So, but anyway.
Yeah,
Yeah.
maybe just a twist on the definition of stable, right? I think we're focused in on lack of volatility, right, and stability of price within a reasonable range. I think the crypto related stablecoin or crypto backed stablecoin are more focused on maintaining stability relative to a peg. So maintaining, if it's an Ethereum backed stablecoin, then maintaining the peg relative to Ethereum, and Ethereum may move up and down, but the peg to Ethereum remains. So we can argue about the utility of that for sure, but it's sort of a different take on the definition of stablecoin.
Yeah, and I come into these events knowing a little bit, so I try to know enough so I can ask a somewhat intelligent question, but I often ask dumb guy questions just because I'm like, I was thinking of a stable coin almost like a money market, but it's really clearly, would a dollar-backed stable coin, would it be fair to think about it like a money market account? They can always redeem 1-to-1? Or is that an inaccurate way to think about it? Anybody? Bueller?
Well, it's probably somewhere between a demand deposit and an MMF, right? I mean, we have examples in history where MMFs have broken the buck.
Mm-hmm.
So
Yes, we do.
Historically, we also have the insights in terms of what regulators have done to prevent MMFs from breaking the buck. And that wasn't that long ago, actually, probably just in the beginning of COVID, we saw that. So I think a lot of people would be hard pressed to make a strict analogy with MMFs, but certainly there are some characteristics of payment stablecoins that are like MMFs in terms of their potential, risks. And in some respects, you might say, oh, it's kind of like more like a demand deposit, except there, when you walk into your bank and you have cash in your deposit account, you can get your cash, right? You don't have to wait 3 days to get your cash typically, right? At least in the United States. Obviously your cash, if you're at an FDIC depository institution is insured. So that's obviously a very different characteristic when you compare it to a payment stable coin. But it, in other ways, maybe feels more like a deposit than a fund. So I don't know. I think it's a hybrid. I've thought a lot about it. It doesn't make sense to me to shoehorn stablecoin regulation into money market fund reform or bank rules. It's just kind of somewhere in between.
And an acronym question did come up. I think you use shorthand for money market fund with MMF.
Yes, I
That's
apologize.
okay.
Money market funds, MMF.
You don't need to apologize. I mean, it just happens because of the way we talk. But just someone in the chat said, "What's an MMS?" And so I clearly
money market funds.
Money market funds. I figured. So here's an interesting question that someone raised in the chat: is given that these guys, depending on what they're backed by, the volatility will change, right? Depending on the backing. Forget about the redemption piece of it. How do you get your money that you mentioned? That risk, Alex, is one. But how are you compensated if you're holding these? How are you compensated for that risk and the volatility?
Oh, that's a really good question. I think it's a little bit left to the RBs of the world. That's just
the RBs,
the arbitrageurs. So
okay, good. Not the meat sandwich. Okay.
No, there is just this entire community that if you go far enough into the Twitterverse and Discord, you will find these communities of guys who do nothing but just constantly trading crypto back and forth all over the place. They're really the ones who are the drivers of all the volatility. If you want to know where does the risk reside or how is it being mitigated, the answer is by holding it. There's the philosophical argument, and there's no point in going too far down it, but those who believe that, if you're watching inflation domestically at 8.3%, their argument is that if I invest or put that cash that I would otherwise have been exposed to a US interest account, and clearly I'm behind, if I'm making 3% maybe in deposits versus losing the value of that money, their belief is that they can actually tread water or maybe even relatively gain some yield by playing things just right in the cryptoverse. So there's two opposing views there. Whether or not it's true is really a function of how they wish to apply that capital. Obviously, if they wish to bring it back into the more formal economy, they're going to have some kind of loss in that transaction. But for the purposes of when they look at high inflationary environments, they do feel, and this is resounding feeling from that community. They do feel that it holds value. It becomes a better store of value or unit of account even than what they would have FDIC or otherwise. And by that, I mean, yeah, their cryptos are not well covered for insurance purposes if something goes sideways. That said, they feel a little bit more comfort in putting it into crypto than they do in the formal economy right now.
So a question popped up that we had talked about prior to the beginning of this broader discussion, and I was going to bring it up later, but it keeps coming up in the chat. And so, to quote one of the audience members, and we would want stable coins because so, and somebody else had said, still for the panel, I'm still trying to figure out what problem this is solving. So clearly there's some things to talk about there. So anybody, you want to take that on, somebody? What problem are we solving here?
So I'll start this off. It's probably helpful to say at the outset that most stablecoin usage today is at the sort of DeFi community crypto native level. People who are trading this or trading Bitcoin and want to store a value and want to wait until the market does what it does to then get back into the trade. So we're not in a world yet where we're seeing robust retail payment use case for stablecoins. That said, we have seen some efforts and some ventures between stablecoin providers and different kinds of money transmitters. Particularly on the cross-border front, there are significant efforts to try and make cross-border remittances a lot cheaper through stablecoins. I don't think that stablecoins are the only way to get there, but they certainly are a path. And so when we ask the question, like, why would we use the stablecoins? I think, who do we mean by we? It's proliferating. I mean, last time I checked, it was probably somewhere like 180 billion in market value or something like that. I mean, it may have gone down since I checked a few months ago, but it may be that retail payments and stablecoins don't work, or that people don't want to sign up for a credit card that's going to give them stablecoin rewards. But what we're seeing, and I think a lot of morning consult, data has shown this, is that today 1 in 6 people in the United States own some form of crypto, whether that's Ether or a stablecoin or whatever. So I understand why people are skeptical, because private bank money seems to work just fine, but there's also another segment of our population that doesn't trust banks at all, or that are unbanked or underbanked. And so, yeah, I mean, there are some people who just want an alternative and feel like they're missing out if they're not involved. So
the 1 in 6 still makes me scratch my head, but I mean, that's a surveying methodology, so that's a whole other question. But yeah, I mean, Alex, I know we talked earlier about what problem is this solving? So I know you had some thoughts on that.
Yeah, if I can just pick up on exactly the one use case. We focus very much on international transactions, cross-border, and we manage everything from the chain of custody of actual delivered goods and the supply chain around that. And then we can also manage the payment settlement. So those two things for us in terms of international trade and exchange, business to business, is extremely important. There's a different world if you want to go into netting at sort of a central bank level, or if you want to go down to low value remittances, but there's this whole interstitial universe. And in that, if you take a look at what the general cost of most exchanges, there are some traditional tools, Nostro-Vostro accounts are a traditional way of balancing and netting between two trading parties. But another option nowadays, especially in an era where there's so much micro trade going on, transactions that are less than $100 per person, but with goods exchanged, when that starts happening, you need to create a way that you can get through all of the traditional tariffs, red tape, custody issues around that supply chain, as well as that trade. There's a whole bunch there in terms of the compliance issues, the regulatory issues, which when you take a vertical analysis of, I have to send something to Mexico, I'm paying 5% on funds transmitted or otherwise, it's really only about 1/5 of that goes towards Forex. Now, Forex is going to be inevitable at both sides, unless you have your own native account with that kind of counterparty's currency. but you've still got 80%, which is just friction on a process that can be readily automated. And I think that the perspective, especially of groups like Ripple and Stellar, who went in very different directions. One is high value and one is low value transactions. But I think what the philosophy there is, there's 80% friction on these processes that can be entirely automated and still be completely compliant. So why can't we start looking at ways to whittle against that and make international trade and funds exchanged, remittances, payments? Why can't we ease that process flow?
I could jump in, David.
Please do. That's the whole point.
I think Alex is on a use case that is probably one of the better ones when it comes to stablecoin, and probably one of the most explored. Cross-border payments, as he just described, has a lot of friction, has a lot of cost, is time consuming, right? We're getting towards instant settlement in some geographies, but we're not there. And so stablecoin has a lot of potential for solving some of these problems for cross-border payments in particular. Then we look at domestically trade payments, B2B payments, some of the same inefficiencies that a lot of firms are looking to blockchain to try to solve for. So I think, questions of speed, cost, being open 24/7, being borderless. Alexandra mentioned sort of the earning power of a stable coin and being able to put that as an earning asset that's different than a traditional deposit or traditional cash. And then I think the last thing I would say, and I don't want to be mistaken for a stablecoin fan or a crypto fan, too much of an advocate, but I will say just the programmability of stablecoin, right? A digital asset allows you to program these tokens into smart contracts, have them released at certain times and certain conditions, if-then statements that allow trade to happen much more efficiently. And that's the point that I think Alex was making around automation that can be built in with using stablecoin.
So does that sound like use cases? So we mentioned cross-border. I mean, that's one thing that even I'm familiar with, just the potential for taking all that as you called it, Alex, friction, but I just see it as margin, out of cross-border. But other than that, a lot of stuff you talked about just now, Sarah, sounded like business to business. Does that seem like where there's more opportunity for stablecoin or stablecoin-like instruments, and rather than on a consumer level?
The flows are so enormous, and the friction so high. I think that's why there's a lot of people starting there. I know there was a question in the chat about remittances. If you look at MoneyGram, they've been in the press recently. I think they've got a partnership with Stellar to try and do something with blockchain, not necessarily stablecoin in particular, but using the Stellar network to help make remittances more efficient. So I do still think that there are use cases around peer-to-peer and retail, but they probably need even less intermediation than some of these other solutions that are completely, still rely on some central authority to try and help money move.
Any comments amongst others on the B2B versus or business versus consumer?
Yeah, I would jump in and say I think decouple the concept of stablecoins from cryptocurrency, and I'll just throw out the crypto issue as fast as can on this one. Currently, it is completely unlikely that there's any value in having low value day-to-day end customer payments with a lot of crypto. And the reason is that the net cost per transaction is still extremely high. If you look at Ethereum or Bitcoin, you will never buy a coffee with those. There's too many inefficiencies in design of the tech itself. That said, they are sort of Gen 1 and Gen 2 ideas. By the time you get a little bit further out, we're coming down that cost curve very quickly that I think you could see crypto payments at the individual to merchant consumer level. The next part of that, however, is that if you're thinking of domestic trade, a stablecoin is not necessarily the right way to go. I'm not pro or against, but domestically, if you're going to be dealing in the same currency, there are other ways to deal with some of those transactions. I mean, we've talked about deposit receipts and things like that. At least we've seen in the UK and in Canada. There's the stable coins that have been set up there aren't actually stable coins that can float and have free trade. What they are is they're a way to manage the unit of account between parties. So there have been a few different advances around that. And I think in a domestic context, there would be a weird convergence at some point that if Walmart insisted that it was using a stable coin in-house versus, you know, the US saying we now have a CBDC, I think, and sorry for the acronym or the
That's all right. Central bank digital currency. NIPE did an event on that a while ago.
cool. So just the point being that at that point, it may not necessarily be the best use case when you're dealing in country, merchant to merchant. So that might not be the best.
So any other particular use case? We talked about a couple. Was there any others that you think look pro? So you talked about costs coming down in crypto, and that makes it the costs that make it impractical to use for small dollar transactions right now. Does that pertain then to, that doesn't pertain to all stable coins, though, does it?
So
No.
we should,
Sorry, Sarah, go ahead.
I was just going to say, we should probably distinguish between public and private networks, right? When we think about the high cost of a payment, often we're thinking about gas fees charged on something like the Ethereum network, or mining costs on Bitcoin. And those expenses, those fees can be very high as a percentage of the actual transaction amount. And those are public blockchain networks. There's an alternative, and again, there's reasons for going public or going private, or public permissioned, where gas fees may be something very different on a private network, where it's some sort of a network affiliation fee in order to participate, but it doesn't have the same sort of cost structure that an Ethereum or another public blockchain would have.
There's another use case that I don't think we've touched on yet, which has to do with how banks are thinking of leveraging some of this technology for their issuance of what they call tokenized deposits. They used to call them stablecoins, but I think that they rightly recharacterized exactly what they're thinking about, which is not a stablecoin that would be issued privately. It would be basically effectively the tokenized version of a deposit. They are currently a group of, I don't know, maybe 10 or 12 mid-sized banking institutions. The USDF consortium is what they're called. And there are variations of these kinds of consortia across the world, but this is one of the more prominent ones. And they're currently in beta, trying to figure out how to come up with an interoperable tokenized deposit across their different institutions. And it's fascinating, really, just to watch this happen, in the absence of rules or regulation around how to do this. They're trying to innovate on their own, anticipating, I think, what will ultimately be some kind of legislative clarity. So there's a lot of interesting development happening within the banking perimeter on stablecoin-like, products.
And so if I could just pick up on that, David, because
Please.
that's exactly the examples that we're seeing in both Canada and the UK that are emergent right now. So we're seeing the tokenized stablecoin or concept, which really is, again, it's just the digital representation. Forget the token piece for a moment. It's just the digital representation of the transaction between the purchaser and the retailer. So, or the bank in some cases with their own merchant clients. So it is just a different representation, but what it's really designed to do is get around the MSB issue, which is a major regulatory and licensing hurdle for a lot of tech companies who are trying to enter the payment space. And this dodges that in a very interesting way.
Well, walk me through that, though. You're talking about the money transmitter, the money transmitter license that when you buy MSB?
Money services businesses, that different terms, different jurisdictions, but generally it's the same sort of issue, is that you need to be able to get over that licensing cost hurdle, which for a lot of these technologies, particularly around distributed ledger technology companies,
Yeah,
they start becoming the money handler, and that's the more stable coin oriented. If they go too far in that direction, then they get subject to different kinds of regulations around those licenses. However, if you stay on we're just providing effectively a secure layer for tokenized exchange and transacting, they get around that because all they're doing is moving a digital record from account to account, which really is the easiest position for them to hold. So when somebody comes in and buys from Walmart, it's just account to account, but they're not actually dealing with it. That's all managed separately, but they can have real-time visibility on their settlement. They just have to have actual settlement elsewhere later on. So you get the speed of the transaction, but all of the other netting that has to go on happens elsewhere. That's a very easy way that it can get managed.
That almost sounds like a definitional. We're not touching the money. We're just moving. A ledger entry from one ledger to another. Is that it?
That's it. It's basically how do we manage the unit of account between the two parties?
I'm saying I'm not great at reading the questions, so we'll probably do those later on because there's a plethora of questions here. But let me see if I can pick one that looks really interesting. I'm not sure what Randy means by MNC. As a guy looking at the support for Goldman Sachs Treasury Operations Technology, the MNC using this
multinational corporations.
Okay, got it. Thanks. See, the acronym world is a non-starter. They sit on tons of liquidity. They manage very, very carefully. They deal in real currency and plan their expenditures days, weeks in advance. Hedge in stable.
70-year-old acronym.
Okay, well, I get behind acronyms sometimes too. So what's the question? The hedge in stablecoins. Who would soak up all the liquidity provided by multinational corporations? Randy, you want to just step in and ask your question?
David, I was responding in the chat to a question before, a suggestion about why not have multinationals use this stuff to hedge against currencies, to hedge against currency risks. And, and I just kind of gave what I thought was a reasonably well-reasoned answer based on 7 years of thinking this stuff through for Goldman.
Gotcha. Okay, good. So it wasn't a question here. It was a chat back and forth to another question. So we're on a tangent there. But anyway, Alex, you talked a little bit about ways of avoiding classification as a money service bureau or a money transmitter. And that kind of brings to mind the regulatory aspect, which we danced around a little bit here, but is very critical to this. And I know, Alexandra, that's something you're particularly familiar with. One question just comes to mind. A lot of this stuff is untouched by regulation. So what's looming out there and how will that affect the viability of different use cases?
So I would say at the federal level, there is no regulatory oversight law that applies to stablecoins yet. There have been multiple efforts across the Senate and the House over the past year to try and regulate stablecoins. There have been proposals from Senator Toomey, proposals from different representatives at the House, and most recently, a stablecoin bill, which I believe will be issued in draft next week, that is intended to be the latest and greatest just on stablecoin regulation. And there have been proposals, like there was a Lummis Gillibrand proposal a few months ago that was broader crypto. It included a stablecoin title, but it was quite ambitious in terms of its scope. And so I think that the lack of regulation in some ways has hindered, stablecoin issuers' ability to scale. Some might view that as a good thing. But alternatively, what it's meant is that risk has continued to kind of grow outside of the bank regulatory perimeter. So, banks are obviously examined, subject to capital and liquidity and other types of rules. They're heavily regulated. They want to get into this space. They're trying to, as I mentioned before, iterate around these kinds of tokenized deposits, but they haven't been given a green light. On the other hand, you have a lot of non-banks outside that perimeter issuing tokens, trying to scale, but without the same kind of level playing field in terms of all the different kind of prudential requirements that applies to banks. And some might say these non-banks are performing, bank-like activities, right? Depending on the product. So there's a lack of clarity in general, but the most recent proposal that I've reviewed indicates perhaps some flexibility on behalf of regulators to allow state licensed stablecoin issuers to come within the federal regulatory perimeter. One of the big tension points in the legislation that I've studied is really to what extent will states have a meaningful role in the future of stablecoins? Anything from licensing to, compliance to consumer protections. That's a wide open field. The most recent bill that I've reviewed indicates that there will be some state involvement. Not clear to me if the federal regulators have given that a thumbs up or not. But that's an interesting space to watch. Most people, I think, that I talk to don't think that there will be a stablecoin law in this Congress. But I do think that a lot of things in the bill will likely survive into the next Congress. And it seems more likely to me that any enactment will happen, likely next year or the following year. So that's kind of a thumbnail sketch of where we are from a legislative perspective, and also some of the dynamics between banks and non-banks.
And that brings up a question that we did touch on earlier in this conversation, which kind of goes to a little bit of the utility, why stablecoins, and that's the idea of disintermediation, because we see a lot with financial technology, fintech over the last decade or two of doing things that banks are unwilling or more constrained in doing. So is this a way of disintermediating players is this a venue or a vehicle for disintermediating players in the financial services arena? Alex, I know you brought this up, or you
Yeah, I'm
said
happy to
we should definitely touch on that powerful loaded word, disintermediation.
Yeah, so again, and I have a bit of a bias here that we are very focused on the international market for a couple of key reasons. So I would differentiate, because we've talked a lot about, having a stable coin operating in a domestic context, being within the US. And if that were the case, we're not really sure that's the best place. And that's not to suggest that a central bank digital currency is a good idea. It's just, it seems that the central bank current private bank money works well enough in most cases. However, when you do take a look at what can happen for large international transactions, I'm looking through the chat and I'm seeing there's some questions around the multinational corporations and why treasurers don't keep this, and why you don't see more multinational corps actually investing in stable coins or keeping them as part of their treasury management strategy. And the short answer, and it's a little bit glib, but the short answer is it's because there's no plugin for QuickBooks yet for it. And so that's kind of the one that we continue to see when we talk to a lot of our corporates. They say, we have no idea how we're going to account for this. And the answer is, yeah, if you're dealing in USDC or you're dealing in another a foreign stablecoin currency, there's just no way to account for it. And that becomes itself, to Alexandra's point, a bit of a product of the regulation not being clear on where do these things sit. You're already seeing companies that are trying to create incentive plans and retirement plans that will incorporate some small exposure to crypto, but there's no way for that to happen yet. There's just not, there's not the infrastructure. There is not risk appetite from multinational corps and nor from most banks. So I think those things have, it's inevitable about any kind of product life cycle that there will be the laggards. And I think in the end, it is not such a bad thing that the banks are the last ones to the party. That should tell you that they're risk averse in a way that should give people comfort about where their capital is being retained. That said, yeah, on the international side, there's a lot that can happen. And I think the number one area that a stable coin fits in is that we look at international arbitrage all day long. And it's these tiny little beeps between two different currency pairs and figuring out exactly how we can facilitate it. There will always be a need for some kind of foreign exchange medium between those two different fiat currency environments and contexts. But filling in all of the digitization that can lead up to that final Forex trade, that's the part that we want to fill in. And that Forex trade can be eased if that Forex partner is more receptive to the stable coins, and they understand what all that digitized asset-backed stablecoin flowing up to its trading side, its clearing side is, then that's how we see the future of stablecoins. It's going to be very much facilitating that Forex transaction to make it as easy as pie.
Just going back to sort of the adoption question and treasurers and CFOs, we actually did a survey. Now this was during this was probably about a year ago, so it was during a different crypto environment and digital asset environment than we're in today. So
They do change quickly, don't they?
yeah, so let's take it with a grain of salt. But we did find that about 52 to 54% of CFOs were interested in using crypto for payments. We found that treasurers were a little bit more concerned, not concerned about the use, but having to deal with the ambiguity or an uncertainty around how do you actually account for this. So I saw in the chat people concerned about IRS reporting. That's always a question. How do you account for it? How is it going to impact your financial statements if you're using a stable coin or a tokenized deposit? Do you need to market? All of those types of questions tend to need to be resolved as well before people get comfortable.
So it's one theme I'm getting here is that the lack of sort of regulatory clarity is limiting the, I guess, would it be fair to say limiting the adoption of stablecoins in a broad way?
I think that's part of it.
Do you
I mean, I think there's also this environment, and we've seen it more on the SEC side, not necessarily with respect to stablecoins, but we are in a very enforcement heavy kind of environment with respect to crypto across the board. So, you know, lack of regulation is one thing, but I think another driver is the idea that you could continue developing a product and then get stuck in the middle of a litigation because you didn't know rules apply to you, or because a regulator thinks rules applies to you and there's no clarity or guidance around how that works. So there are a lot of dynamics that I think are impacting how companies scale, including stablecoin issuers. And many of them are not just building here, they're building across the world. Like Circle is one of the largest stablecoin issuers. That's USDC. They now have a Eurocoin as of a couple months ago, maybe. So they have a new fiat pegged currency in Europe. And if you look across the world, a lot of major developed countries, UK, EU, Singapore, South Korea, they are already, well ahead of the US in terms of their crypto specific frameworks, which I'll say also includes stable coins or e-money tokens, I guess, if you're in Europe. So yeah, those are all important impediments, I think, to kind of where stablecoin issuers feel they are here. And then it's not just issuers, right? There are all these other third-party providers. They're wallet providers, right? That there are exchanges that work with stablecoin issuers to make this product real for consumers. So it's this whole kind of ecosystem of players that I think has been crying out for regulation. Some of them have even tried to apply to be OCC regulated banks. It's not clear that's a path, or at least an efficient one. So it's kind of a mess a little bit, but some folks are hopeful.
Well, I mean, this is so much change in such a short period of time. And would you see then, is it a correct inference from what you were saying that the lack of clarity around regulation is inhibiting some people from trying new things?
That's my personal view. I don't know if Alex or Sarah want to chime in on that.
I would agree. I think it keeps people on the sidelines to a certain extent. I do think that we have continued to see, even in this crypto winter that we're in, we're continuing to see traditional finance, the traditional, TradFi, exploring things, but and they're taking advantage of the fact that there's now a lot more of this talent available than there was, say, 6 months ago, where you could not get a blockchain engineer because they were all multimillionaires many times over because of the crypto markets. And so they're using this time to really invest and build things, but in terms of bringing things out into the market and getting them sort of going forward with, again, getting product live. We're not seeing a huge amount of speed in that regard. And I think a lot of it is the regulatory overhang or uncertainty that Alexander mentioned.
Alex, you're furrowing your brow. Does that indicate you have a comment?
I would echo both of my co-panelists on this one, 100%, that the lack of framework there has been hugely inhibiting, and it's always a deterrent because it then can quickly frame things in a way that, until somebody says it's legit or it has some kind of fiat support one way or the other, until that happens, it's totally understandable that the vast majority of persons would be extremely wary of even getting their toes wet in this. That said, the other side, and it's the one that I see frontline every day, is that the technology side is advancing extremely quickly. And that brings with it a couple of challenges. Obviously, I mean, you could take the Terra Luna argument and blow that one up as it did itself and say, well, there's a reason why we can't just rely completely on the technologists, which is not wrong entirely. But it also means that technologists have been, I think, fairly poor in being able to communicate to regulators. It goes both ways, however. When we talk to regulators and we try to explain the difference between a DAO versus a smart contracts layer versus a stablecoin, it's just eyes glaze, and we understand that it's incredibly boring stuff, but pulling apart what the differences are, both practically and philosophically in these things, has been a bit of a challenge. So I think, yes, the regulatory framework's got to be at the table, but I also think that the people who are developing the technology have to be a little bit more proactive in delineating what the application is and what the jargon is about how these things can be applied. And hopefully that will give the regulator a little more comfort in saying, okay, I understand that this particular stream, this isn't of huge concern to us, but now we understand why this one is. I think they're getting there. I mean, I think that's why they're now starting to focus on stablecoins and not just blockchain in aggregate.
So there was another point that we talked about earlier that I thought I would bring up is you had mentioned this earlier, I think, when you had central bank digital currency. So that's in fact, even in some of the, I think in the bill that you were just talking about, Alexandra, isn't there a part of that was encouraging more study beyond the what was issued from the executive branch to study central bank digital currencies and to put more emphasis on that. So if central bank digital currencies become a thing, if you start seeing them coming out in large scale, will they minimize or obviate or somehow impact the viability of stablecoins?
So I really would not be holding my breath on a CBDC.
That's a good point.
I think that the bill, to answer your question, provide, or at least the draft bill provides for a report on a study regarding CBDCs. It's a report, I believe, between the Fed and FinCEN. I think that was probably a concession, frankly, because I think the Democrats probably wanted a more fulsome green light on a CBDC. And it's not clear they'll get it, but we'll see. It's just a draft bill. And so there's a lot of disagreement about, a question that's come up just in the past hour on what's the problem with CBDCs trying to solve. And of course, there are different use cases. There's the retail payment CBDC, and then there's more of a wholesale payment financial institution model. And it's a series of extremely complex issues that are very wide ranging. But I will say at a high level, if the United States were ever to adopt any kind of CBDC, it's not going to be in the near future, even with congressional approval. There's going to be a ton of piloting and iteration and modeling and, public-private, engagement, which is important. And assuming I'm right about that, I think the bottom line is, stablecoins will already have had a pretty significant head start as yet another form of money, to the extent that they have shown real risks, both, run risk, we talked a little bit about that, but there are other risks associated with private stablecoin issuance and a CBDC that I think still need to be solved. And it may be that because stablecoins are here, that the stablecoins kind of develop and address those issues first. And so that the main issue, which we haven't talked about, but is a real issue, is this problem around interoperability, right? We live today in a multi-chain environment. We have many different types of exchanges, many different kinds of stablecoins that operate on all these different exchanges. And so there are real risks associated with the transfer of value across these different chains. And there have been examples, and some of you have maybe read about them in the news, about software issues and other types of illicit activity, hacking and otherwise, when folks try to transfer their tokens across chains. So the interoperability issue in this multi-chain blockchain environment is a real issue, and I think is actually getting some attention in the draft bill. Similarly, for CBDC, imagine the technical challenges involved in converting a US dollar CBDC into some other form of currency. How are those systems going to be able to interoperate and understand each other, I guess, is I'm sure Alex can give the more technical explanation. So even if we assume we'll have a world that coexists, in multiple forms of money, stable coins, a CBDC, there are some common challenges there. And I think maybe stable coins, given where we are going to have, a pretty significant heads up on some of those issues, which might make a CBDC, may pave the road for a CBDC in a much, clearer way. It's entirely possible. But I can see them coexisting. I don't think that's a crazy idea. I just think it's going to be a while.
I'd throw out the question that we've been getting a lot, like, why do you need a stable coin? I would throw out a question maybe, why do you need CBDC if you have well-functioning stable coin markets or market? So if you have stablecoin issuers who are following the prudential requirements of banks and who can protect, have the proper consumer protection, have assets properly segregated, have the ability to unwind, have the right processes and controls in place as a bank would have, why might we actually need a CBDC? It's a rhetorical question. I don't actually know the answer, but just sort of throwing that out there.
Well, I think it depends on your perspective. I think if you're the perspective of a federal regulator, or you're the Fed, you want to be able to provide consumers with another option of some kind of tokenized, form of money that is backed by the central bank. Perhaps you feel that is, I shouldn't say perhaps. Regulators, I think, generally take the view that that is a lot less risky than a private stablecoin issuance, because you've got basically the full faith and credit of the central government, of the central bank, excuse me. And so from that perspective, I think, Governor Brainerd and others have been on record as saying we should really think about this so that the private